According to recent data from the China Automobile Dealers Association, the country exported 270,000 used vehicles last year, with that number expected to hit 400,000 units by the end of this year.
What if the booming electric vehicle market in China isn't as stable as it seems? What if the companies leading this rapid growth, like BYD and others, are actually struggling behind the scenes? With prices being slashed, suppliers being squeezed, and a massive reliance on government subsidies, could the whole industry be on the verge of collapse? Stay with us, because what you're about to hear might completely change the way you think about the future of the auto industry and the companies that are supposedly dominating it. If you're new to our channel, take the time and subscribe. Recently, China's car market has been struggling. The economy is not growing as quickly as it was before, and car companies are facing intense competition. To stay ahead, many companies have started lowering prices aggressively. This has led to an odd situation where new cars are being sold as used cars with 0 kilometers on the clock. At some dealerships, you'll see hundreds of BYD cars parked, all registered and given plates. Still, they haven't actually been bought by customers. These cars are almost brand new, with some having driven only a few kilometers, yet they are labeled as used cars to boost sales numbers. Wei Jianjun, the chairman of Great Wall Motors, recently revealed a troubling issue within the car industry. While capital investors have already earned their profits, some early backers have sold their shares to car makers. Manufacturers are reducing spending on key areas, such as safety, durability, and reliability. Some cars that were once priced above 220,000 yen are now being sold for just over 120,000 yen. Wei questioned how a product could lose 100,000 yen in price and still guarantee the same level of quality. He made it clear that this is not feasible. For buyers, what seems like a bargain could turn out to be a risky investment in terms of product quality. Wei also shed light on the chaotic situation of the 0-kilometer used car market, where cars are registered as sold but are later listed again on second-hand platforms. These cars, often sold by thousands of sellers online, were never actually delivered to genuine buyers. This in turn allows the company to justify increasing production, even though it results in an accumulation of unsold inventory. Wei is widely recognized in the industry for his straightforward approach, and he didn't hold back. His comments about the 0-kilometer used car loophole have sent shockwaves throughout China's auto industry. On May 27, 2025, the Chinese Ministry of Commerce convened an urgent closed-door meeting to address the issue. Representatives from leading industry organizations, tech research centers, and car manufacturers, including Dongfeng and BYD, were invited, along with second-hand car platforms such as Watsu and media companies like the Dorian Group. According to a source familiar with the situation, the ministry's goal was to discuss potential solutions for increasing sales of these unused cars that were registered as sold. Because the meeting was confidential, the source requested anonymity. Following the discussions, the stock prices of Chinese automakers, including BYD and Leapmotor, fell further, each dropping by 3.1%. Additionally, the Hang Seng Auto Index in Hong Kong also declined by over 2%. When cars labeled as 0-kilometer used flood the market, buyers often find that their vehicle loses value almost immediately after they buy it. If issues with the car arise later, there's no clear answer about who should handle the repairs. This leaves many consumers in a difficult position with nowhere to turn. Many young buyers are still paying off their car loans, thinking they bought a new vehicle, only to realize the truth later. Dealership workers are losing their jobs and auto parts suppliers aren't getting paid. Ultimately, everyone is being caught up in this dishonest system, becoming victims of a larger industry collapse. During the interview, the host referred to an online comment suggesting that trying to put others down doesn't help raise oneself up. Wei responded saying that it all depends on what kind of light it is. If it is a misleading or false statement, he would certainly correct it. His response shocked viewers, and it quickly stirred a lot of conversation online. Many auto reviewers came forward to support Wei, acknowledging that he is one of the few in the industry willing to speak honestly and expose the fake success surrounding the market. Currently, Wei Jianjun stands out as one of the few individuals openly confronting the problems in the car industry. He compared the situation in the auto sector to the collapse of Evergrande, pointing out that similar signs are already showing in the automotive market. Some may feel that his comparison is an exaggeration, but it's worth considering the actions of Evergrande before its downfall. The company had relied heavily on high levels of debt despite its cash flow continuing to worsen. They also expanded into new markets without clear plans while falsifying sales figures. Executives within the company were paid excessively high salaries and received suspiciously generous benefits. They even resorted to using promissory notes to pay suppliers, which led to financial struggles for those suppliers. Lastly, when the company faced increasing scrutiny, it spread the notion that it was simply too big to fail. After hearing everything Wei Jianjun said, it's clear that the same issues are unfolding in the car industry. The main difference is that the collapse hasn't happened yet. Wei has consistently advocated for fair competition and has called for an industry where cost-cutting and low-quality products are not the norm. He has been fighting for the long-term success of China's auto industry, but things have taken a turn for the worse. The industry is now in complete chaos, with many carmakers cutting corners to lower prices, pressuring suppliers to reduce costs, and manipulating numbers to boost sales. Wei knew that speaking out would upset many, and he has faced a great deal of online criticism as a result. Interestingly, in recent days, the head of PR at BYD posted 2 cryptic messages on Wei, which appeared to respond to the ongoing criticism. In the first post, he shared 3 pictures of dogs, accompanied by a message suggesting that while dogs can bite people, people cannot bite dogs. In the second post, he shared a movie poster for Candle in the Tomb. While these posts were unclear in meaning, they quickly gained attention and even made it to the trending list. Some online speculated that he was implying that Wei Jianjun's comments were nothing more than noise or barking, and that his posts hinted at a personal response to Wei's remarks. This reaction reflected a sense of guilt, as though there was no need for an accuser when the truth was already evident. Wei Jianjun's comments had a significant impact on the Hong Kong stock market. On May 26, 2025, shares of several automakers dropped sharply. BYD dropped 8.9%, Leap Motor lost 8.8%, and Great Wall Motors saw a 5.2% decline. Examining the financial data, BYD's revenue in the first quarter of 2025 actually surpassed Tesla's, posting a record net profit of 9.15 billion yen. Great Wall also reported profits. Many major automakers in China have debt ratios ranging from 60% to 80%, with only one company exceeding 90%. However, none are in default. These high-risk investments are often hidden from the public in off-balance sheet entries. What's even more troubling is the quality of the profits. According to Tsinghua University's Auto Research Institute, the average gross margin for China's electric vehicles is under 10%, whereas Toyota has a steady margin of 20%, and Tesla's margin is over 25%. And how sustainable is the long-term growth of their exports? While the battle to lower prices, secure subsidies, and chase funding is still fierce in China, things are starting to take a turn for the worse internationally. Countries such as Thailand, Brazil, and Hungary have already begun facing challenges from Chinese car brands. The US followed suit by increasing tariffs on Chinese electric cars to over 100%, and India has even banned the import of Chinese-made cars altogether. More than 6 million electric vehicles were exported from China in 2024. Still, a large portion, over 35%, were low-profit models with basic features. A significant 60% of these vehicles went to markets that offered zero tariffs and generous subsidies. But these advantages are quickly fading. At the Munich Auto Show, BYD surprised many by reducing the price of its Han EV by 20%, resulting in a sharp decline in profits. Foreign customers who had bought the car for 150,000 yen found that just 6 months later, its value had dropped to 100,000 yen. Wei Jianjun explains that dropping the price of a car from 220,000 yen to 120,000 yen, while still claiming it meets the same quality standards, is simply deceiving customers. People may think they're getting a great deal. Still, in reality, they could end up with cars that have downgraded features, like missing airbags, poor quality batteries, and hidden safety risks. The risks are well known within the industry, but they are often kept hidden from consumers. Companies like BYD are successful because they are quick to move. Still, their success ultimately relies on tightening the supply chain and generating revenue through exports. The question is, how long can this last? The entire rise of China's new energy vehicle market has been primarily driven by massive government subsidies. Still, once these subsidies begin to decrease, the whole model will be at risk. In 2022, China provided a massive 92.4 billion yen in subsidies for electric vehicle purchases. With additional tax breaks, infrastructure support, and local incentives, the total value of government backing for the EV sector reached nearly 500 billion yen, equivalent to around 20% of China's education budget for the year. Every electric vehicle sold in China was supported by public funds. However, on January 1, 2023, China officially ended its national EV subsidies. Layoffs became more common, resulting in fewer features in new models, and the supply chain continued to shrink. Many supporting businesses quietly closed their doors. Since 2023, over 400 companies in the EV supply chain have gone bankrupt or been deregistered, with more than 70 of them being part suppliers. Without subsidies, the entire ecosystem supporting electric vehicle production begins to break down. Without a strong ecosystem, car makers are left with empty shelves and no way to continue production. Today, many car manufacturers are relying on bank loans and asset-backed financing to stay afloat. However, once the cash flow dries up, the next major crisis is likely to emerge, threatening the entire industry. BYD has been making ambitious moves in recent years. Since October 2021, the company has acquired over 1.44 million square meters of land in the Shenzhen Cooperation Zone. This site is expected to generate more than 200 billion yen in annual output and become a primary hub for electric vehicle production in southern China. Additionally, BYD has built several factories in Dongguan, expanding the EV supply chain into the industrial area. To maintain its position as the world's largest electric vehicle maker, BYD must leverage its size to compete with Tesla and other domestic competitors. In 2024, the company sold over 3 million vehicles and is aiming for even higher targets in 2025. The company owes suppliers 240 billion yen and has more than 4 billion yen in loans and supply chain financing. Unlike Tesla, which operates with a 3-month payment cycle, BYD takes between 12 to 18 months to pay its suppliers. Although these figures are not officially verified, they reflect growing concern in the market about BYD's heavy debt and the strain it is placing on suppliers. BYD currently leads the electric vehicle market. By 2024, auto loans are expected to surpass 3 trillion yen, and EV-related financial products are projected to exceed 200 billion yen. However, many companies, including BYD, have less than 3 months of cash reserves. If sales even slightly decline, the effects could be disastrous. To wrap things up, the Chinese auto industry, particularly in the realm of electric vehicles, is facing significant challenges. From fake sales data to companies pushing unsustainable prices, the cracks are starting to show. Even the most prominent players, such as BYD, are feeling the pressure. The current approach of relying on subsidies, squeezing suppliers, and cutting corners may work for now. Still, it's a risky game, and the bubble could burst at any moment. Significant changes are on the horizon. If you enjoyed this video and want to stay up to date with more stories like this, make sure to hit that like button, subscribe, and turn on notifications so you never miss an update. We'd love to hear your thoughts. Drop a comment below and let us know what you think about all this. Thanks for watching, and we'll see you next time.